Good evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo Nightly video for August 21st, 2019. We're talking a key level because we have the potential for the market to break resistance and travel up to new highs. Is that the dominant thesis, or is that the alternate thesis, or stated differently, is that the higher or lower probability outcome from where we stand right now? We'll tackle that and more in tonight's video. First, let's take a look at where we are on the S&P 500. We'll get the screen bigger and just focus on price levels. And the S&P futures, we do look at gravity spots, but on the S&P 500 cash index, we'll start with that. Not much difference. The levels are important. So going back, we are clearly referencing 2940. It takes us to 2018 and prior high 2019. A little bit of resistance, and I'm going to draw our attention here momentarily. But first, the breakout, resistance, support off of 2820, roughly speaking. And then now the pivot into 2930. All those levels just to say this, that the market has critical and clear, almost like clear and present danger, clear and present resistance, just shy of where we are now. And that gives us a thought plan for the rest of the week. And of course, the Jackson Hole, Wyoming, or at least the Federal Reserve announcement or their annual meeting, which we'll learn this week. So that's going to be the catalyst that could result in a breakout above resistance toward all-time highs. But before we do that, let's focus on this level. So if you are trading, the dominant thesis is the bearish one, is the sell swing. Why? How? Looking at our S&P futures or the cash index here, we see the market once again into the underside of our falling daily moving averages. We also see weakening volume. We'll see that in the S&P futures, but all of that takes place until about 2930. That being said, let's look at our S&P futures. At same level is in play, but we have one extra spot, and that's Don's gravity spot, 2911. And the market is pivoting away from this 2940, 2930, and again, those underside of the moving averages. We also have, into the mixture, declining bull volume. And that makes us bearish just because of that. And some reversal candles, so we won't belabor the point. We won't give 10 different reasons, but we'll just put it this way in simple terms. The dominant thesis is the bear one. The probability rests with the bears or sellers or short sellers. The prudent thing to do is to short into resistance, get long volatility, and to play bearishly against 2925, 2930, or maybe even worst case scenario, 2950. And that gives us another, this is the first one, second one, and this one was truncated or stopped in its tracks in today's session, but nonetheless, a bear bias against 2940. Now, of course, if that doesn't happen, the alternate thesis is the breakout one. And this is a whole lot of open air. A lot of short sellers have stop losses, as they should, or hedges that they will put on in the event that the market breaks above. Let's just say 2950 for a round number, or 2946, 45, etc. That would push us into alternate thesis territory, trigger a whole lot of stop losses, and short squeeze the market at least to 3,000, probably above that. Is there precedence for this? Can we look in the past and see where this same logic came into being? Plenty of examples, but we'll take you to June of this year. So this is a similar outcome. This takes us into the middle of June 2019 with the market falling, new lows, falling moving averages, but now we have this 2900, 2911 gravity, bearish reversal candle, 1, 2, 3, 4, 5 days in a row to the upside. Each day was met with bearish or weaker bull volume. The dominant thesis is for a sell swing. The prudent thing to do is to short sell the market and to expect it to trade back lower, this time to the underside or the above side, top side of those daily moving averages. So that was a plan. As the next couple of sessions went on, we got some downside action. Short sellers were rewarded for putting on short sold positions or getting long volatility into 2900. And we can see the bull volume creeping up a little bit here. So that's a warning sign. And then we had other small reversal candles, and the same logic is in play. The market should fall away from 2900, 2911, trade a little bit lower, fill out the range, and if that doesn't happen, the alternate thesis or short squeezes, stop losses of the bears are triggered, will be triggered above 2915, 2920, all the way to new highs. Fortunately or not, or unfortunately, whatever the case may be, the alternate thesis, unexpected, short squeeze, take a lot of the bears and cause them to stop out. Well, that triggered a market rise on the breakout with the gap and go, 1 session, 2 session, 3 sessions to new highs. And even beyond that into where we are now. So we simply do wait for, look for, trade for a bearish swing up against 2930. If you are short, remain short, but just as a caution sign or an opportunity. We'll do it from two perspectives. The first one is a caution. If you are short, do not be blind, biased short and suffer significant losses if the market rallies above 2950, because it could stop, or I guess stop going up, at least at 3,000, maybe even above that. And if you don't take the positions off or hedge or roll or something else defensive, that will be a 50 to 60 to 75 point rally of financial losses. The opposite is true if you are an intraday trader. We'll be looking to play bullish breakouts. This includes individual stocks. Target, for example, was up 20% today. Lowe's was up a similar amount. And those are retail names, and that's actually a little bit of bullish news or bullish sentiment beyond the headlines. So that's going to add a little bit of bullish activity to the market. And if the Federal Reserve this week, or their announcement from their Jackson Hole annual meeting, that could be a catalyst to cause the market to trigger stop losses, and in the triggering of the stop losses to quickly rally, short squeeze, break immensely higher, I guess not immensely, but maybe 50, 60, 75 points in the S&P futures toward new highs. Not in one session, but over 1, 2, or 3 sessions. And again, where's the precedent for that? Right here. And that was the middle of June 2019. So that's what we're watching right now. That's the main thing I wanted to communicate in tonight's video. Be prepared and celebrate. We'll all have our bear caps on, all of our positions in out spreads or bear put spreads, or even some sold bear call spreads will be in the profit zone. But if that doesn't happen, and that's just an acknowledgement that we as traders trade the market, we do not forecast the market. And we are ready, or should be ready, prepared, and knowing what we will do in the event we do see another short squeeze. It could be a 3-day event, 2-day event, or maybe all of next week. Now, key focal levels that are similar to that same logic in the NASDAQ would include, let that load, and here's the same logic. The levels won't be the same, but it's roughly 7,800. And this is the same kind of conversation. So 7,800 should come against it. Oh, no, new highs. So watch these levels very, very closely for the NASDAQ traders. 7,800 should come against it, should sell against it, should be in bear spreads or long volatility because your bull volume is declining. But again, markets aren't going to move because we want them to move or because we're positioned. And sometimes those bigger moves occur when one side of the market is trapped and forced to exit. This would be the bears, and I think the majority of the trading community, myself even included, are going to be positioned against these levels, expecting them to hold or expecting the market to trade against them. We need to be prepared this week, Thursday, Friday, into next week for the lower probability, but yet bigger magnitude or bigger short squeeze outcome if that happens. In the Dow futures, we'll take a quick look at that. And the level to watch, maybe not as impressive or not as clear, but that spot to watch in the Dow mini futures is just about 26,200 or 26,500 in this zone. And if you're a Russell trader, we'll take a look at that before we conclude tonight and get ready for the announcement from the Federal Reserve. Now this Russell keeps being weaker and is a relative strength laggard because it's not even anywhere near the prior high. So we're not talking about that in terms of the play. However, the Russell is compressed under its 200-day simple moving average and the 20-period exponential, all of which align at about 1520. Case in point, protect yourself. Think about the risk. And the risk is for a massive short squeeze that I think a lot of people in the trading community or even the world aren't ready for. So be ready for it, team. All right, take care. This is Corey Wisdom with your Theo Nightly video for August 21st, 2019.